Okay, let's answer some questions from the last market outlook. Number one here, been fascinated by the theta portfolio you've outlined in the applied series, wondering about how one should go about taking losses while selling puts, buying spreads. At times you may reach a loss of 2x your premium well before the expiry without the underlying actually reaching the break even, therefore making your actual break even loss limit dependent on a combination of the time left to expiry and the price of the underlying. I get what you're saying. So that if we think about a timeline and you have expiration over here, and let's say you sold a $50 put, and we'll just make this a stock chart, and the stock price was at $62 when you sold it, and it starts dropping, and it is now at $57, but you've hit your limit over here. Let's say that you got 75 cents for it, and now this put is selling for $1.50. On one hand, you have hit your rule. On the other hand, you're still $7 out of the money in this sense that it's only 57. Your put is at $50. And the stock could just turn around and go up. Yeah, there are times where you would end up taking a loss where you otherwise wouldn't have to take a loss. But this is what we want to protect ourselves from, where suddenly this is now $40, and you have a $10 loss for making 75 cents. It only takes one of these to wipe out a dozen to 2 dozen good trades. Unless you really understand the underlying, number one, and number two, you've decided that you're only going to sell puts on underlyings that you're comfortable owning. So that if it does go down, you say, I really don't care. If I own it, I'm going to put it over to my other portfolio, which is either a buy and hold portfolio or some other strategy portfolio that you have. Maybe you're building an allocation on this one as well. Then it doesn't matter. Then yeah, you can't lose because, well, you want to own it anyways. And who knows what the price is going to be tomorrow, or who knows what the price is going to be a week from now. Forecasting price is notoriously difficult to do. It is much easier to think about, are there forces that suggest the price should go up, or are there forces that suggest the price should go down, without trying to come up with any kind of price target. But if you're comfortable owning the underlying, then yeah. I sell puts myself. I do a lot of this. I only sell puts on underlyings I'm comfortable owning. For example, Oxy. I'm out of the market now because I'm moving out of Canada, so I do have to pare out of everything that I'm doing because by early December, I have to transfer funds out of Canada. But for the course of the year, I was selling puts on Oxy heavily. And if it was ever put to me, I'm good with it. I made a lot of money selling puts, rather than saying, I'll put a limit order in, right? I'll put a limit order in of 57.50. I can write, hang on, 57.50, let's say for 2,000 shares. Rather than do that, and wait for it to get to 750, I'll sell puts at 57.50. Again, 57.50, and maybe I'll get $1.50 for selling those puts, and I'll sell 20 of them. So if it is put to me, I'm really buying it for 56. But if I was comfortable putting a limit order in at 57.50, I should be comfortable selling puts at 57.50. I should be comfortable with that because I do better. And I sold a lot of puts on Oxy every time it dropped, and they all worked out nicely. And again, if it was put to me, great. So I think that that will help answer your question, is to avoid this sort of thing. You may want to limit your put selling to only those stocks you would be comfortable owning. Now, for some people with small accounts, let's say you only have a $10,000 account, that would put you out of business very quickly, because you'd only be able to have maybe 1 or 2 names put to you before you say, well, that's it. I don't have any more funds. That is the risk of having small accounts. With small accounts, you're more likely to place spreads. So you'll sell spreads if you want to generate income as opposed to selling puts. Let's go on to the next one here. The establishment survey had a quarter of all jobs added in accommodation and food service. Wondering if this has anything to do with student loans now needing payment. Those industries also saw 1.8% weekly payroll growth, but the aggregate private sector payroll increase was 0.2. If you strip that out, the employment situation actually looks pretty sideways. Would love to know your thoughts on baristas and bellboys buoying the job numbers. It wouldn't matter. It wouldn't matter if that were the case at all, because aggregate incomes are higher. And if we assume a constant marginal propensity to consume of, let's say, 95%, let's say that is the marginal propensity to consume, the jobs numbers, if you take the establishment survey, the number, and multiply it by the average weekly earnings, it added 400 million to the economy on a weekly basis. And if we assume a marginal propensity to consume of 95%, an average tax rate of about 30% on personal incomes, you've got 280 million as disposable income, and 95% of that 280 million will be spent each week because of that high marginal propensity to consume, especially at lower incomes. So it wouldn't matter where the spending power is coming from, as long as the spending power is coming. Is it sort of a signal in the economy that, hey, listen, if these are the jobs that are being created, it's not that great? That might speak to limited upside from here, but because you have that incremental spending happening in the economy, that doesn't really speak to a cratering of employment. The economy typically doesn't roll over that way, where you get small job losses for a period of time, and then at some point you hit a recession. There's usually some event that causes some retracement of employment or some layoffs, and then that then accelerates the process, and it usually is a very fast process. So I don't know that there's a lot of information in the incremental month-to-month changes that are going on that could suggest, hey, this is a leading indicator, that's a leading indicator, other than exhaustion at hiring, but not necessarily eagerness for payroll cuts. On discussing the ballooning yields at the long end of the curve, you suggested it's caused by a confluence of factors. True. And weak hands, I'm not sure what you mean by that. Well, weak hands are people who are holding these bonds and seeing the loss in value, saying, that's it, I'm out, and selling them without understanding that you won't lose by holding the bond. The capital part of the bond is decreasing, but your coupon stays the same. That doesn't change. And as each day goes by, that bond is in some small part pulled towards par. That as the expiration date creeps forward on the calendar, that bond will be pulled to par. But you do have weak hands. Weak hands are those that say, okay, I'm out, I'm done, and then they start selling. So that selling then causes some investors to also sell, because they can't watch the capital portion deteriorate without understanding that, with stocks, you can have capital that just deteriorates, and if it's a bad company, boom, you could get to zero and lose it all. But with bonds, even if they deteriorate, if this is the maturity, even if they deteriorate, at some point on the calendar, it's not going to be enough. That this will start to be pulled to par. It's just a mathematical necessity of the way time value works. It will be pulled to par. That you don't really have to ever be concerned about this. So weak hands, yeah, there are some that will sell. As the selling happens, they will start selling as well. Agency has been confusing me of late. Expected price movements to be highly correlated with changes in the spread. Usually they are. A widening spread currently seems to correlate with price increases on agency. Am I wrong in believing this is counterintuitive? At some point, the reinvestment in MBS at wider spreads represent future opportunity for income. So if they can reinvest their cash flow at these cheaper prices, the question then becomes, you're hedging out the interest rate component, you're levering up the spread. How much wider can the spread get? You get to a point where the spread is so wide that you're a fool not to buy it, simply because, where's it going to go from here, right? What other factors are at play? Sentiment. Really, sentiment, any kind of negative sentiment on the sector, good stuff will be thrown out with bad stuff, because trading in ETFs, an ETF that holds it, if there is a reduction in the shares outstanding of ETFs because there is selling, because there are redemptions, then everything, the basket of shares would have to be sold. So sometimes you get this passive selling, this indiscriminate selling, because the seller of the ETF is not really sure about the components. It's just saying, I don't want to be in this ETF anymore. Why is it important to look at market expectations like interest rates and inflation rates? That is a big question. It's because the time value of money is probably the biggest law governing prices, is the time value of money. And if we think interest rates are going to be higher in the future, that means future money is worth less today. If we think interest rates are going to be lower in the future, that means future money will be worth more today. And every asset we buy is an asset with a stream of cash flows. And we value that asset by some forecast of what those cash flows will be in the future, and some forecast of what interest rates will be in the future, so we know what to discount those at. A video where you break down your tax strategy with your move to Costa Rica. I will be putting up a video probably on the weekend sometime of why I'm leaving Canada and all of the details. A whole bunch of information that I can share with you about, what I found down there, what to look for, what to watch out for, what strategy you would use if you were going down there, things like that. I'll share as much knowledge that I've accumulated with you. When would be a good time to start building a position in MBS? Well, I guess the question, or the answer to any question like that, is you tell me your time frame and I'll tell you when. If you say, well, I'm a short-term trader, 3 to 6 months, then at that point I would say, as soon as it appears that the Fed is on hold. In other words, once they signal that rates are not going to go any higher, that means their next move is most likely down. That's probably where you want to be. You want to wait till you get that confirmation, which means you're not going to get 100% of the move. But you have confirmation that rates aren't going to go higher. Maybe they'll go lower. If you are a long-term investor, let's say you're going to look at 3 to 4 years, I would say it doesn't really matter. Go ahead and buy now. And have an allocation strategy. Buy 30% of what you want now, and in 1 quarter buy another 20% of what you want. In another quarter buy another 20%, and you'll dollar cost average along some price curve. And I think consistently that's the best outcome, because you will never consistently buy at the bottom and sell at the top. You may get lucky a couple of times in your life and say, I bought that right at the bottom and I sold this one right at the top, but it's not a strategy that you can replicate. And if it is, if you do have that ability to buy at the bottom and sell at the top, I will employ you for big dollars. I will employ you if you can show me that you can consistently buy at the bottom and sell at the top. You come talk to me. Before anyone else, you come talk to me. How do you interpret the change in money market fund assets and the Soma holdings? Well, I don't know that there's much to interpret. Soma holdings there's no interpretation necessary. It is the Fed saying we're going to let 60 billion of treasuries and 35 billion of MBS run off every month, period. There is no intention and no strategy in that statement. There is no market information in that statement. It is simply operational. There's nothing to interpret in that. Money market funds, well, this is money entering into these funds that are, for a number of reasons, a lack of interest in anything else, a lack of understanding of anything else, money coming out of equities going into money market funds, money coming out of long end of the curve going into money market funds. Listen, when cash is paying 5.5%, that's generational, right? It's not going to, in a couple of years, you'll be looking back at these cash rates and saying, remember when? And in 10 years, you'll talk to somebody who says, were cash rates really that high? Yes, they were, my son. Yes, they were. I don't know that there's much interpretation there other than it's a great return on cash. Now, if cash were yielding 1% and you saw money flooding in to money market accounts, then you would have to say, what does that mean? Then that requires interpretation. But when brand new Corvettes are selling for $20 and there's a lineup, you don't have to interpret that. You don't have to interpret that at all. What are your go-to options setups for cap gains when you don't hold or intend to hold the underlying? I can't wrap my head around how bad the RRs and the credit spreads are. How bad the RRs and the credit spreads? I'm not sure what this means when we're going from option strategies to credit spreads. Even after considering the high profit probability, it doesn't make sense to enter any spread based on a payoff for 100 trades. Payoff for one. I am not understanding the flow of the question here. When you're my go-to option setups for capital gains when I don't want to hold or intend to hold the underlying, well, I mean, what's my motivation for not holding the underlying? I don't want the underlying, but I'll play the options. I don't want to actually own a foreign currency stock with a dividend, so I'll use synthetic long positions. I want to get leverage on a market, so I'll use options instead of it. I have a whole bunch of reasons why I'd never want to hold the underlying, not just one. And I don't know that I have a go-to option setup. I don't know what it has to do with the credit spreads, and this spread based on the payoff for 100 trades I'm lost on. I don't know what that means either. Are there corporate bonds available in IB? Yes and no. Yes, there are corporate bonds available that you can list the corporate bonds. You can actually see some of them, but I believe you have to call the desk. You need a dealer to get that done. So I don't think you're going to be able to buy it through the exchange. Even the treasuries are not exchange traded. The treasuries listed on IB are just intentions. But you can execute through the platform, but it's not on any exchange. It's just a price that the dealer market can see and say, oh, okay, well, there's somebody here that wants this. For Canadian bonds, you have to call. I think for corporate bonds, you have to call as well. Anything like T-bills, but with a higher yield. So that's not bonds now. If you're talking about T-bills, those are money market securities, not bonds. I don't know. I've never looked up any of the money market securities. I imagine there must be some listing for very liquid commercial paper. There must be. I've never checked. Would it make more sense to look at the equity risk premium of the S&P instead of multiples? You can. The multiple is just a more consistent way that's easy to understand. The equity risk premium is rather difficult to understand because you have many more assumptions in there. For the multiple, the only assumption we have are forward earnings. And usually it's consensus forward earnings, which means it's the forecast of many analysts that come to a consensus. the average of all of them. But for the equity risk premium, it is what's your look back period to calculate your beta. Because changing your look back period will change the beta that you use. What is the risk-free rate that you happen to be using? Is it a T-bill rate? Is it a long bond rate? So there's a whole bunch of, and for the equity risk premium, the premium is a point estimate with a distribution. So you could say, for example, here is something that anybody familiar with statistics will immediately understand, but those who aren't may think it's odd. Let's say that you have a distribution and you say, well, the equity risk premium is typically about 450 basis points. With a volatility, some volatility, let's say, or standard deviation of 200 basis points, which means if you draw out your distribution and you do a 90% confidence interval, you could have anywhere from 50 to 650. That if you have an equity risk premium of 75 and you do some hypotheses testing on this, your test would fail, and you would come back. You'd fail to reject the null, and you would come back and you would say this number here is statistically no different than this number here. So just because you have a low equity risk premium, the equity risk premium is the point estimate of a distribution. Statistically, is it different than 450? Not absolutely. We can't, when you're talking about statistics, you can't say, well, 75 is different than 450. We have to say, is it statistically different than 450 at, let's say, a 90, 95, or 99% confidence level? That becomes a lot more difficult because you have an inference that you're making. That's inferential statistics. You have an inference. You have a bunch of estimates tied up in your equity risk premium as well, and you have estimates that are sitting in your standard deviation. So because there are more estimates that go in there, there's more room for error. But it is useful if you can interpret it. It's easier with the multiple. If you look at ERP of the S&P, it is with the close on Friday more expensive than it was July at 4,600. Using the long bond, you're probably right. Just want to confirm my understanding on purchasing a treasury bond. If we were to buy February 15th 48 T-bond in Interactive Brokers for 10K, 10K would be the face value. Yeah, what you bid is the face value. So if you bid a quantity of 10,000, that's 10,000 of face value. And what the account would be debited. No, the account would not be debited the 10,000. 10,000 is the face value you buy. And the market value would be what the bond is trading at, which is around 7,000. Correct. So you can buy $10,000 worth of bonds and you'll pay $7,000 for it because it's the price is about 70%. If you're looking at the 100-point system, I think it got as low as 70.9. I see a 3% coupon. Correct. Yield is showing to be 5%. So you'd still get the 3% coupon. That is your question here. You still get the 3% coupon. The 3% is on the par value. Your cash yield, that is your coupon, which is 3%, a coupon yield of 3%. Your cash yield is the $30 you'd receive. Well, $7,000 you'd receive 3% of this. You'd receive $300 over the $7,000. That would be your cash yield. We would still get paid 3% coupon each year and yield to maturity 5%, which assumes those coupons are reinvested. No, you don't have to reinvest the coupons at current interest rates. That's a big misunderstanding. It is part of the IRR calculation because yield is a money-weighted rate of return. Money-weighted rate of return. So let's say you buy something at 700 that is going to mature at 1,000. And over the course of the year, you're going to get paid $30 on that bond. But that bond will also get pulled to par over the course of a year. That's some of your other yield right there is the pull to par. This would be the cash yield. This is the pull to par. The combination of the two is called your rolling yield, because you don't know that yields won't change. To realize when you buy it here, let's say you have a yield to maturity of 5%, and you get your coupon payment. If you take your coupon payment out, then you will still have a yield to maturity of 5% all the way to maturity, because you're not adding more money. But typically in portfolios, what happens when you get the coupon is added here. Now you have more money. And since the return is money weighted, to achieve the 5% yield to maturity, you would have to reinvest this new money at the same yield to maturity. Otherwise, you'll end up in the future, when you calculate what the portfolio yield to maturity was with all the cash flows coming in, will be less than 5% if you can't get 5. And if rates continue to drop, or if rates do drop, you'll have a yield to maturity in the future for the portfolio that's less than 5%. If they continue to rise, you're reinvesting at higher and higher yields. You'll have a yield to maturity or yield to maturity of the portfolio greater than 5%. This is the beauty of bond portfolios that is, I think, not quite understood. So let me see if I can impress upon you how beautiful this is. Let's say that here's our timeline. Here is the future where we want to be. This is par. We're going to get par. And let's say that par, we're going to get $1,000. And we can buy a bond today for $700 that pays $30 every single, pays $30. We'll get $15 every 6 months on this. Now, I'm doing it very simply with just one bond. But bond portfolios don't just have $1,000 bond. They'll have 100 million or 200 million in a particular bond, right? Well, let's just assume that this is what we're going to do. And yields increase and the price of the bond drops. And the investor is like, oh, come on, man. Like, it's going down. I'm losing money. You're not losing money. You have been granted the opportunity to do better than you did here. If this was a 5% yield to maturity, when you get this $15 coupon, you buy $15 more of the bond. Now you can't because it's in $1,000 increments. But again, you have to start thinking in terms of large bond portfolios, right? So they get 15 in and you buy. Well, this yield over here might be 5.3%. And the price continues to do this, and then you get the next $15. Well, this might be 5.6%. Now you're reinvesting your coupon at 5.6. At some percent, the bond has to be pulled to par. It has to be pulled to par. It's a mathematical necessity. It will be pulled to par. So if yields drop and you don't need this money, if you're 35, and you say, I don't need this money until I retire at 65, and you buy a 25-year bond, you have the opportunity, and you say, this is 5%. In 5 or 6 years, everybody will be wishing that their bonds had 5% yields. I'll be able to sell it for a huge capital gain. In the meantime, even if the yield drops, I get to buy at higher and higher yields. I will do better than my 5% on my yield to maturity. I will do better. Where you won't do better is you plan to hold it for 25 years. You bought it here, you get 5%, and it starts rising in value. Well, then you're reinvesting at 4.6%. And then over here, you're reinvesting at 4.2%. Well, then your yield to maturity on your reinvested, on all of your money, because again, this is all money weighted, will be less than the 5%. So when you buy bonds, what you'd like is for the first little while, really go down and allow me to reinvest more. And hopefully you have a job, which means you're saving money over time. So every quarter or every month you say, my excess savings, buy more bonds. Excess savings, buy more bonds. Excess savings, buy more bonds. Because at some point, this has to be pulled to par. It has to be pulled to par. That's the beauty of this, is that you can do better than your original yield to maturity if you're given the opportunity to reinvest your coupons at higher and higher yields, which means lower capital prices. But you have to understand bond math, and you have to say, that's just lower prices for now. That's no big deal to me because I'm not retiring till 65. This is a good yield to get, and I'm willing to hold this bond. And I know sometime in the next 3 or 4 years, bond yields are not going to stay at this price. They're going to go up, and which means I just have to be patient. And I will not lose. If you're patient with bonds, you will not lose. Okay? All you can do, if the price goes down, all you can do is say, okay, my yield to maturity now on my bond portfolio will be higher than I originally thought. Nothing wrong with that. I understand your position on TLT and the long bond. Are we able to explain why you are less interested in the 20-year bond? Well, because TLT has a duration of 17.6, roughly a duration of 17.6, right? 17.6, which has an interest rate sensitivity. So if interest rates drop, TLT should increase for every 100 basis points that the yield, and the average maturity is 25 years that it holds. So if 25 years, if the average maturity drops by 100 basis points, TLT should increase by 17.6%. If I want the same exposure, I have to get the same duration. I've got to get the same duration. The 25-year offers me the same duration. Now, I can get the same duration by taking, let's say, a 17-year low coupon bond and a 25-year zero coupon bond. The combination of the two would give me the same duration with huge tax efficiency. However, because I have no coupon here and low coupon here, I don't have regular coupons to reinvest if the yields continue to move higher. And I'd have to have some kind of contribution strategy to take advantage of that. But I can use a combination of bonds as long as I can replicate TLT. As long as I can replicate the sensitivity or the factor exposure to duration that TLT has, I'll do it. The 20-year bond just doesn't have the duration component. So I'm not getting, when I sell TLT and I buy the 20-year bond, I'm not quite getting the same upside move in the bond that TLT would give me. And if I'm selling that, I want the same upside, right? Let's see if there's anything else. Is it because you believe low duration given by 20-year makes... well, there it is. Yeah, I have answered it. Yeah. Curious about your thoughts on the paper discussion, how dividends are irrelevant. They're not irrelevant, but I understand the argument watching Ben Felix's video, and he said it's like moving money from one pocket to another. How much weight do you give to the other academic opinions? It's not like moving money from one pocket to another, okay? So let's put a person over here, right? And let's give them two pockets, one on either side. That looks kind of funny, right? Now, if this person reached into this pocket and moved money over to this pocket, we would say, yeah, it is like moving money from one pocket to another. But let's put another person over here that represents the company, and let's give them two pockets as well. It is this pocket, money going from this pocket to this pocket. So you're not moving money from one pocket to another. You're moving money from the pocket of one entity into the pocket of another entity, because leaving it in this guy's pocket over here or this girl's pocket over here, there could be mismanagement. Maybe it's invested in a bad way. Maybe they have no real investment to have, so they have it sitting around in cash and marketable securities earning almost nothing. So Apple has billions of dollars sitting in marketable securities earning a cash rate. And investors in Apple are saying, why not give me that money in dividends so I can buy more Apple stock? Because Apple stock, in their opinion, in the long run will do better than cash. Why are you holding the cash and getting a cash rate? Give it to me and I'll just buy more of your stock. So it is not the same thing. By you receiving the money, you are now free to make the investment that you would like to make. However, taxes come out of that. So there is a loss in the taxes, but the money in your pocket might be safer for you than the money in the company's treasury, because what if they do a stupid acquisition? What if they just start spending money on a project that doesn't go anywhere, like the metaverse, and they spend billions and billions and billions of dollars and then say, maybe we should focus on efficiency, right? So it's not the same as moving money from one pocket to another. It is moving money from the pocket of one entity into the pocket of another entity. Now, there is some saying that, well, dividends are irrelevant. They are, because you can manufacture your own dividend. Let's say there's a stock at $50 that doesn't pay a dividend, and it goes up to $60, and you'd like to have a 3% dividend. Well, then every year you say, well, $50, I want $1.50, sell $1.50 of whatever stock you have. Sell 3% of whatever stock you have, and you'll create your own dividend. And you can just keep doing that. So as long as the stock is rising, you can create your own dividend. But if you're only going to reinvest the dividend, then you do nothing. Dividends, there is a dividend irrelevance theory suggesting dividends are irrelevant because you can manufacture your own dividend like this. But there is something called the bird in the hand theory that says, whoa, 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 which counters dividend irrelevance. Bird in the hand is what I just said over here. The company made $1,000. I own 50% of the company. It keeps $1,000. Well, I own 50% of $1,000 that's in somebody else's bank account. Give me my half. Give me my 500. It's in my bank account. Well, that's a safer place for it to be than in the company's bank account, because now I am free to invest it in something that the company may not be willing to invest in or will not invest in. I am free to do it myself. So a bird in the hand is worth two in the bush. You've heard that expression. So you have dividend irrelevance, saying you can manufacture your own, and you have bird in the hand saying it's better that I have it than you have it, right? I think this one here dominates more. Not only that, a good stock with a dividend yield will be well supported in terms of price. It tends to be less volatile. In other words, good dividend-paying stocks tend to have a beta less than 1. So it's not really irrelevant. In last week's Q&A, you mentioned some big bank economists, analysts have historically been much more accurate than the Feds. Could you provide examples of some of these people off the top of your head? Off the top of my head, I really don't know. Macro is a tough game to play. But I would seem to think Ed Yardeni has probably been more accurate. Now, I mean, he's wrong, just like other people are wrong, but I think he's been more accurate and consistent than the Fed itself. I'm sure there's a lot of people out there that follow different macro analysts that could give you a bunch of names of people who were sort of better at it. And I mean, you have some portfolio managers that consistently do beat their benchmark, which means they must be better at it. They must be better at something than the Fed. With agencies' financials held relatively constant, would you almost always be a buyer of them whenever their share price drops below their tangible book value per share? Yeah, for agency, yeah. That doesn't mean every mortgage REIT. Some mortgage REITs are just poorly managed, like Invesco. I don't know why they have a problem on their mortgage REIT side, but they just seem to be badly managed on their mortgage REIT side. But agency is well managed, and they stick with agency MBS, which is got a de facto government guarantee. So yes, I think I would be a buyer every time it is below their tangible book value per share. I think that's a great opportunity. Do you see the war between Israel and Hamas having a ripple effect on the macroeconomy or market? That is so hard to determine. I think there are knee-jerk reactions to what's going on. I think, it's the one region of the Middle East that just doesn't seem to have oil, but it's oil proximate. And you have the interests lining up on each side, not so much doing anything, but saying we support this side, and you have other countries saying we support that side. If it comes to anything more, I think the big risk here is Israel deciding that it wants to do a preemptive strike against Iran before Iran does anything. If they think that Iran might doing something to Iran before Iran does it to them. I don't think Iran has the appetite to do anything against Israel with the U.S. sort of throwing its full weight behind Israel. I don't think it has the appetite for that. I think it has the appetite to certainly speak its mind, but I don't think it would go much further than that. I think the bigger risk is Israel, sort of saying, look, they're going to do something. Our intelligence says this. Let's hit them first. I think that would be the bigger risk. But these things are non-linear when they happen. They're unpredictable. If this was predictable, it would have been stopped, right? So we know that this was unpredictable. It was unexpected, and here we are. One thing that we can count on is the unpredictability of its future course as well. Nothing is as determined that you could just say, well, here's what's going to happen with it. You have to consider the possibilities. And yes, it's within the realm of possibility that this could spill over into something more. It's also within the realm of possibility that the way Israel is just pummeling Gaza at this point, that more countries in the world start saying, okay, he's down, all right, enough. It's like watching a fight and the guy's on the ground and the other guy's still just kicking him in the head. At some point, you got to step in and say, okay, he's down. Enough. He's down. So who knows? I really don't know on this one. But I do know that it now is on the radar. You got to put it up there. You got to say, okay, well, we got to watch this as well. I know you've commented on this before, but could you remind us of the significance of the inverted yield curves that are now uninverting? One element that I remember you saying is that the typical 2-year, 10-year will uninvert shortly before a recession. Typically, it does so with the 2-year dropping. The 2-year dropping, not the 10. It typically uninverts with the short end dropping in anticipation that the Fed is going to cut rates because things are getting bad. I forget the details of the significance of it all. Yeah, so typically that is what would happen. Bear steepeners are rare. We did have a bear steepener in, I believe, early 21, the first part of the year, the first quarter of the year. Rates were still low, but there was a bear steepener on the long end, followed by a bull flattener of it after that. What really set this one off was the Fitch downgrade. I mean, if you can remember back to the Fitch downgrade, that was the beginning of it. And the last time, I think it was S&P, the last time there was a downgrade from S&P, 3 months later, it was pretty much over. It was like, okay, that was over. There was the market threw a little hissy fit about it and said, oh my God, the debt. And then it was pretty much over because they remembered, oh yeah, they can print money and tax. Forgot about that. It's not a company where we have to think about the sustainability of its cash flow. The U.S. Treasury and the U.S. government can manufacture its own cash flow. I don't know that I'm too concerned about this. But I would not, this idea that it uninverts before a recession. Keep in mind, recessions, when we look at a chart and we see all the recessions, those recessions are dated years after, 2-3 years after it happens. The dating committee says, here's the date it started, here's the date it ended. But while the curve is uninverting, it certainly felt like something going on. Right? But it's usually the short end of the curve. So I don't think that this is the uninversion that precedes a recession. This doesn't feel like that kind of uninversion. This is an odd one. This is a very odd one. How to calculate dollar delta beta for your portfolio? For your portfolio is very difficult to do because if you have a whole bunch of positions, you have to calculate each position. Your broker should do it for you. You know how many dollars you have available. You can look at the market value of your position. You know what delta you have. You can look at your option and see what delta it is. If it's stock, the delta is 1 for every share that you have. It's the beta. You need a look back period. Usually about 2 years is the right look back period, but beta is an estimate. It's just an estimate. So whatever delta dollar beta you get is your best guess. And this is the variable. This is the one that makes it not a nice, clean, perfect measure, because beta is not an objective number. It's a statistical number. And it would change depending on the look-back period that you use. Attended a seminar in San Jose, Costa Rica. The presenter was formerly a resident of Saskatchewan. I've always pronounced it Saskatchewan because it just sounds like an indigenous word, Saskatchewan. And I just imagine that that's how it was said. Ever since I was a kid, it was Saskatchewan. I know it's Saskatchewan, though. He said his friends back home all wanted to know how he liked living in Costa Rica. Some were thinking of possibly joining him there at the Invisalign factory. He told them unless they can put up with the constant rain for many months of the year, they should probably think of someplace else. Well, if you're from Saskatchewan, you have cold weather and freezing rain, or just freezing weather for 6 months, 7 months a year. So you can freeze or you can use an umbrella. I mean, it's your choice. And listen, we had a summer here where it was pretty much raining every day, every second day. I only swam in my pool 4 days this year, 5 days, I think, because it was just raining all the time. I'd rather put up with rain and 22 degrees than put up with shoveling snow in negative 10 degrees for 6 months. Call me crazy, but I'd rather do that. He has, after 6 years, returned to Canada. I don't know if it was the rain that did it. It's like, God damn it, I hate the rain. I would rather lose 53% of my income and freeze. Okay. If the rain really bothered you, come on back and lose half your income to the Canadian government and freeze in Saskatchewan. You mentioned in the jobs report, day video, that the dollar is strengthening on the back of market and bond sell-offs and left us hanging as to where the money is going. And this is the exact question I've been thinking about lately. Please do tell us where this money is going. I don't know. I just have a theory. I have theories. I really don't know where the money's going. If money's leaving equities and money is leaving fixed income and the dollar's going up, money's coming into the dollar, where the hell is it going? If it's not going into financial assets, we know housing sales are quite low. Commercial real estate sucks. So in case it's not going into real assets, where the hell is it going? So it probably is not even entering the U.S. What it could be is that when you have the price of oil going up, which is pretty much traded in U.S. dollars around the world, and you have the U.S. dollar that's going up at the same time, countries that are net importers of oil need U.S. dollars. And because the value of the currency is going up, they need more and more U.S. dollars. They may be selling their U.S. treasuries to get U.S. dollars to meet their commitments under their importing for oil, which means that other countries, the demand for U.S. dollars increases in other countries, which when I floated that, I said I tried to find quotes for, if you're looking at a cross-currency basis swap, what's the quote for the basis? And if it is elevated, that means there is a heightened demand for US dollars in the world. That would be consistent. But if the basis were really low, there again, I'm back at the point of saying, well, where's the money going? It's a puzzle. But I think that's the missing piece of the puzzle here, is what the basis is. And if it's elevated, that doesn't explain the strength of the US dollar. It would give evidence that there is a demand for US dollars, and that's why the US dollar is going up. But I don't know where to get the quote for the basis. I think this is a very particular thing. You need access to dealers to get that. But if somebody out there has that information, please share it. Past L2 with your content, was wondering if I can buy L3. Oh, already answered that. What do you think the main contributor to the bear steepener and bonds selling off? I don't know that there is a main contributor. Fiscal irresponsibility, increased supply of debt. We've had fiscal irresponsibility for years, decades even, ever since we got out of the 90s. We've had the U.S. has been involved in these forever wars. Iraq cost how much? Afghanistan cost how much? And then you had policies under Obama that added to the debt. Then you had the tax cuts from Trump without the spending cuts on the other side, which added to debt. Then you had the pandemic, and you had the pandemic spending. Then you had the dumb, stupid $2 trillion inflation reduction spending. That was stupid. But it is a function of politics. So it was stupid timing. It was a dumb time to do it. Not that it was a stupid thing to do. It was just a stupid time to do it. But there was no other time that the party in power would have allowed it to happen. So here you go. And let's say that this is the business cycle, and here is where they say we are. Growth was still there. Inflation was high. The last thing you need at that point in time is more stimulus spending, more fiscal stimulus spending from the government. You don't need it. This is where you need it. For the next recession. Save it for the next recession. Save it for then. Okay, that's when there should be deficit spending in recessions to cushion the blow. Save it for then. But the Democrats could not let the Republicans have it, which means you gotta do it before the next election, because you got to get elected. So you're not doing this because it's good for the economy. You're not doing this because it's the best thing for everyone. You're doing it for the D. You're doing it to get votes. This was to get votes and nothing but votes. Screw the deficit, screw the population, screw everyone. This is the better time to do it for everyone. This is the better time to do it. For the health of the nation, let's do it. Let's spend on infrastructure, but let's spend it at the right time. When we need to create jobs is exactly when everyone else is shedding jobs. We can play a role in diminishing the effect of the business cycle. But we cannot let the other party have it. We can't just put it on the shelf and say we've got something saved up for the next recession. We have to fire off every bullet in the gun that we have now, whether it's the right time or not. That's the problem with politics, right? So you've always had fiscal irresponsibility because of this. Growth expectations increasing. Yeah. Foreign central banks selling treasuries to shore up their currencies. That could be it too. Rates, real rates above 2%. So inflation doesn't seem to be the main concern. That would sort of suggest that the inflation premium would come out of the long end. I don't know that I'd say that I'd cross that one off the list. But yeah, I think it's a confluence of things all happening at the same time. I think it would be different. I think it would be very different if oil prices were going down and the US dollar were going down. I think there'd be less yield pressure on the long end. I think at that point yields would probably rally, or yields would lower, bond prices would rally on the long end if you had that happening. Let's see. I don't know all the reason. If a 30-year matured this year, the current owner is more prone to invest in short maturities. We don't know that. You don't know that. Or money market funds and in long-term bond to maintain the same kind of duration. You don't know that. Keep in mind that so let's say you have a portfolio with a whole bunch. Well, first of all, if it was originally issued as a 30-year bond, it hasn't been a 30-year bond for 30 years, right? So if it's in the portfolio, it's let's just think about a portfolio today that has some one-year bonds, 2-year bonds, 3-year bonds, 4-year bonds, 5-year, all the way every year all the way to 30 years. 1 year goes by and you think, well, okay, if this matures, since I have to match the duration, it's got to go back into 1-year bonds. Well, first of all, this is now a 1-year bond, this is now a 2-year bond, this is now a 3-year bond, and this is now a 29-year bond to maintain the same duration. You have to put it in a 30-year bond. Even if this 1-year bond was 29 years into its 30-year life, it is not just that one single bond every day that's getting closer to maturity. It's every bond in your portfolio. So if you structure a portfolio with bonds, the next day, all those bonds are 1 day closer to maturity. All of them are 1 day closer to maturity. So to bring your maturity back up, because your duration, your average maturity drops every single day, which means your duration drops every single day. To bring it up, to bring the duration up, you have to invest in a maturity with a duration that's more than the weighted average duration of the bonds that you have. So you'd have to go to the longer end of the curve to get it done. So no. At the same time, worldwide wealth creation should be measured against the growth in new debt by governments. Treasury is adding approximately $1 trillion of new debt every 90 days, with central bank doing QT and an inverted yield curve, discouraging duration by commercial banks. Should be measured against the growth in new debt. No, why? It's not like the growth in new debt reduces the amount of wealth that's created. That wealth has to go somewhere. If I have $1 million and I have no place to put it, I got to find somebody who wants to borrow $1 million and I can charge him an interest rate. That doesn't change the fact that I had $1 million. If suddenly savings grew to $2 million, well, then you got to put it somewhere. So you need financial assets to put it in. If there are no companies doing IPOs and nobody wants to sell their shares to me, I need somebody to borrow the other $1 million. So you need somebody who's willing to borrow the money that is got the ability to keep paying you back. At least since 2008, the private sector has reduced its leverage, but the public sector has grown it substantially. Even I got a problem with the word leverage here. I know you think I'm picking on your question. I'm tearing it apart. Leverage is you need some notion of equity to start talking about leverage, or some notion of assets to talk about leverage. Public sector, or at least government, doesn't have that kind of balance sheet. We don't know what the equity of the government is, so we don't know what its leverage is. We know what its debt level is, but we don't know what its leverage is. Whereas you can calculate leverage in the private sector, whether it be household debt, whether it be corporate debt. There is a notion of equity because they have a balance sheet, assets, liabilities, and equity. Without that, you're not going to get leverage. But if you did calculate the assets of the government, its leverage is super, super, super low. Okay, super low. And you may be thinking, what are you drinking over there? So let's just think about the equity over assets for an individual. And let's say that you have $1 million in equity and $2 million in assets. That's very low leverage. If you had a $2 million house with $1 million of equity in it, you really only have a mortgage on 50% of your house. That's really low leverage. Well, what are the government's assets? Okay, so it has debt. Call it 30 trillion because some of the debt is owed to itself, so cancel that off. What are its assets? Well, how much land does it own? Keep in mind that it also owns a whole bunch of the resources under the land as well, depending on what resource it is. So there is a royalty on everything that comes up, and there is also a lease on that land as well. How much property does the U.S. government own in terms of buildings? If you think about that. Also, you have tax revenue. You have that as well. So if we were going to do a balance sheet, you would have to list all the land, add up all of the reserves, the known reserves, and calculate some kind of schedule over which those reserves are pulled out, calculate what the cash flow stream is, present value it, and list it on your balance sheet. List all the value of the property on your balance sheet, all of the present value of the future tax revenue you're going to get. That would come to way more than 30 trillion. So if we're looking at debt over assets, then because that's really all we can do. If you're looking at debt over assets, then you can get to some measure of what equity would be. Leverage for the government would be super, super low, super low. So we can't talk about leverage when it comes to government. All you can talk about is the absolute level of the debt, and usually the best way to do that is not the dollar amount, but the percentage of GDP that it is. Even if the government has the ability to raise tax, the politician would still have a hard time doing it. Yes and no. It would be difficult to raise tax rates except on successful people, because there's not enough of them to vote. So if you have more democratic or liberal governments, they are absolutely willing to tax successful people and to demonize them and to call them names and to call them tax cheats, to say they don't pay their fair share. They're not willing to talk about the sacrifices those people made to get there, the investments those people made to get there, the risks those people took to get there. No. That would be humanizing them. Let's just demonize them, and let's give the voter someone to hate, and I will destroy those people so that all those other people will say, yeah, let's take them down a notch or two. I'm going to get stuff. So yeah, if there are tax increases, it's going to be on successful people. More than likely, there'll be different taxes brought in. There'll be new taxes brought in. There'll be taxes that don't change your tax rate, but change how much disposable income you have, because the taxes will be in different places. Royalties will go up for oil extraction. Land leases will go up for oil extraction and mineral extraction. All sorts of ways a government can raise taxes. The capital gains tax can go from a low rate to a higher rate, because why should capital pay a lower tax rate than labor? Will be the cry. The dividend buyback tax of 1%, I guarantee you that's not staying there. Taxes, new taxes, and a tax on successful people, right? A tax on capital, a tax on wealth. It never ends. I think long duration is an attractive bet, but given the odds of something breaking in the economy and the sell-off, but given the political dynamics, I see it maybe more tactically than a structural long-term bet. I think it's a long-term bet. Listen, we've always had a clown show in Ottawa and in Washington. It's always been a clown show. But I cannot see, and maybe I'm wrong on this, I cannot see how in Canada the Liberals can get reelected. I cannot see this because everyone's looking at these yields right now. It's affecting everyone's lives. They're all becoming aware of the sheer weight of government debt and the sheer ridiculously of the spending and some of the stuff that they spend money on. Enough is enough is sort of what you're hearing on both sides. Whether you vote red or you vote blue, enough is enough. And I think it's only Republicans, perhaps, and conservatives, at least conservatives in Canada, that seem to want to say, we got to cut the spending. We've got to cut this spending. Liberals think they'll lose elections if they cut spending, but something has to happen. So, I think the voter, for the most part, over the last 15 years or so, have abdicated their responsibility in electing responsible, qualified people. And we now elect popular people, and we elect people who are not the people we hate. I'm a liberal, so I hate the conservatives because they're all Nazis, and of course the media that you watch feeds that to you and keeps that going in you, that you can't possibly think the other side is good. Look at all the evil things they do. The media, and Trump had this right. The media is the enemy of the people. They are the enemy of the people. If you're looking for a massive source of misinformation, it's mainstream media. Here in Canada, CBC. You can't watch CBC and think you're getting the truth. You cannot and think you're getting the truth at all. Let me give you an example of that. When we had the trucker convoy in Ottawa, everyone was there. Even Fox News was there. But what was really interesting is you had a lot of YouTube people there. Streamers, live streamers walking around. Like you had 8 or 9 good channels of people walking around and showing what was going on. For the most part, there was really nothing bad going on. However, one streamer showed us what CBC was doing. CBC was walking around. They weren't filming anything. They were walking around and walking around and walking around until they found the worst possible example that they could find. Somebody flying a Nazi flag. I'm not going to draw it out, but they were flying a Nazi flag. And they set up their cameras and they said, oh my God, let's get this, let's get this. That's what CBC did. And then they left. But the streamer, what the CBC didn't show is the truckers then came over to these guys and said, get that crap out of here, take this down, get lost, you're not part of us, and chase them away. And CBC just put this up as an example of what's going on. This is what we have down here in Ottawa. And then they left, and they could have had lots of footage. Now, if you watched the streamers that whole period of time, everyone was getting along, everyone was nice, they were interviewing people who had legitimate gripes that just weren't being heard. They weren't being heard. And CBC misinformed the entire country about it. Right? This is what media does. Now, why would CBC do that? Is because under the Conservative government was saying, listen, CBC, you got to stand on your own as a media company. We can't keep taking taxpayer dollars. But Trudeau came along and said, I'll give you $1 billion. If I get reelected, there's $1 billion in there for you. So CBC gave the Liberals glowing coverage. When it came to light that Trudeau was caught 3 times in his life wearing blackface, CBC gave it like 45 seconds, but no panel discussion. But when it comes to light that a Conservative MP, when they were 5 years old, stole playing blocks in kindergarten from the girl beside him, there was a panel discussion. There was, should they resign? And it spilled over for the whole week. It was the whole, and I'm making that up, obviously, but it's that kind of thing, that if a Conservative did the slightest thing wrong, there'd be a panel discussion for 40 minutes on CBC. But if Trudeau wears blackface 3 times, it's mentioned, and then we move on. We just move on. Let's move on. That's misinformation. That's the media. I don't watch CBC. I don't watch the National anymore because it's nothing but the Trudeau Power Hour. And, enough of that. Anybody who watches CBC knows that it is state-funded media. It is just a Liberal mouthpiece. And they're there just to glorify the Liberals and to paint any other party in the worst possible light that they can. I know I went a little heavy on that, but trust me, if you listen to Fox News and you say, okay, I'm getting good information here, go listen to CNBC or MSNBC and listen to what they're telling their people. Or if you listen to MSNBC, go over to Fox News and listen. Both sides are misinforming. Both sides are misinforming, grossly misinforming, because the goal is to keep you angry at the other side. Not to inform you, but to keep you angry. And we have abdicated our responsibility as voters to elect responsible government. We don't elect responsible government. We elect popular government. And they turn into popularity contests. I'm not confident that a lot of austerity will enter into budgets in the future, because that doesn't get you reelected. So if you have any kind of wealth, they're going to come for it, because they're not going to tax the bottom 50%, because the bottom 50% doesn't have an income to tax. They're going to tax success. And in Canada, that wealth tax has already been floated. That 2% wealth tax, let's come back each year and grab 2% of the money we've already taxed, and let's just keep doing that. For no other reason than you have it. No other reason than you have it. Simple question, when I'm doing expected return for just say any asset, probability value, how do I find the probability of possible returns? Well, any expected return, as I said earlier, is a point estimate. So a return means nothing on its own. So there's your expected return. What's more important is the distribution. So you have your expected return. What is your volatility? Because that will set up your confidence interval, right? I understand the probability has to equal 1 for just say good economy, bad economy, flat economy. Oh, okay, so you're doing scenario analysis and you want to weight the scenarios. That's subjective. A lot of that is subjective. You just sort of make it up on your own. Or you could use historical observations saying, well, markets go down 30% of the time, they go up 70% of the time, so let me just use those. Or you could say, given the times that we're in, I'd put 50% on, poor economy, 25 on average, and 25 on good. Then your base case is poor economy. Example, this type of analysis, make sure I'm doing this correctly. Quick step by step. For scenarios like this, that's just, what do you think? It's really subjective. I mean, how can you possibly say, I think there's a 46% chance of recession? Where did you come up with that? It's a lot of it is just, well, I started with 30% and then I moved it up 15 because of this, and then I added another 1% for good measure. Wow, you just make the numbers up. Early in the video, you expect interest in buying the Mexican peso. Are you still considering that trade? Yes, I am. Yes, I am. I think this is probably Mexico's decade. You have northern states, unions in northern states, shutting down companies. You move down to southern states, they are right to work states, not in the northern states, and you move to Mexico, you got much cheaper labor. So, automakers are doing what they can with the union, but they're not going to stop moving to Mexico. Money's not going to stop flowing into Mexico. If you're nearshoring, if you're putting resiliency into your supply channel, you got to go somewhere, and Mexico has cheap labor. Cheap labor. You have, U.S. auto workers that want, what, 170,000 all in per year. Mexican labor is 10 grand, $5 an hour, 10 grand all in versus 170 all in. Where you think you're going to go, right? So yeah, I'd still be interested in the peso. How does the Fed impacting federal funds rate impact the banks? I need a brief of the process behind this and want to link the short end to the long end to the bank's borrowing rates and lending rates. Well, that's a complicated question altogether, but every day a bank has to balance the banking book, has to balance it, which means if you had money coming into the bank that day, more money coming in than going out, you have a surplus, you got to put it somewhere. If you have a shortage, you got to borrow it, and usually it's the overnight market, and that's where the Fed funds rate comes in, is it affects that borrowing cost directly. So your incremental cost of borrowing money is going to be the effective federal funds rate. If you're in the repo market using your treasury as a security, that is the price you're going to pay for your incremental borrowing cost to balance your banking book. And then it gets more complicated from there depending on what it is you're trying to get done. It may not be overnight based on cash needs. It may be a term repo for 3 days or 2 days, along with some overnight borrowing. But it is not something I can do in 3 minutes. It is more detailed. If you've got the applied series, go into sector studies. From sector studies, go into financials, and in financials there is understanding banks. There's a 5-part series on understanding banks. I think it comes to 4.5, 5 hours of video there, and you'll see where all of the I guess the balancing that you'd have to do if you were a bank in terms of both sides of the balance sheet. You'll see how that plays a role. 30-year fixed rate mortgage spread stands at 2.77, but if you look at agency MBS, they trade an average yield of only 5.7, implying a much lower spread. Well, lower spread based on where they originally bought them, perhaps. So to me, it looks like agency MBS are not as attractive as the 30-year fixed rate mortgage. No, no, you can't just look at the yield. You have to look at the maturity combined with the yield, right? So you have to look at both. You can't compare a 10-year yield with an MBS that has 4.5 years left. It's going to have a lower spread. You have to compare it with an MBS that has an average maturity of 10 years given the PSA speed. The PSA speed is the speed of prepayments. So a 30-year very rarely lasts 30 years. Very rarely does it last 30 years. It typically has the same duration as a 10-year bond, which is why you look at the spread between the 10-year Treasury and the 30-year bond, because the 10-year bond has a bullet payment at the end and you get coupons, but MBS you get principal back each and every time, along with prepayments that make that 30-year mortgage typically much less than a 30-year holding. You're typically paid out much faster than that. So you do have to look at, well, what is the average age of the MBS that they're holding, and compare it with a Treasury, with the same maturity. Well, even if you say, well, 6.5 years, let's say, it's still, because of the prepayments, you still don't know if it's going to be 6.5 years, longer or shorter. So it's hard to make, on a portfolio level, it's hard to make that kind of direct analysis. I could not find direct info for the forward rate part. 210, 2Y, 10Y. That's not forward rates, that's slopes. Is that from the SOFR forward curve page, but we need to calculate ourselves? No, that's just the slope. You take a yield on the 2-year Treasury and the yield on the 10-year Treasury and look at the difference. So it would be the 10-year minus the 2-year. And right now it's like negative 30 some basis points. But that is just a slope. That is just subtracting 2 yields. It has nothing to do with the forward curve. So for forward curve is the forward curve of 1 month or 3 month rates, a year out, 2 years out, 3 years out. But it's still just a 1 month or 3 month rate. It's not a 2-year or a 10-year. Even if you're going out 2 years and looking at the forward curve, the 2-year going out 2 years looking at the forward curve for SOFR would tell you what the expectation would be for the 1 month rate 2 years from now, or for the 3 month rate 2 years from now. If I sell a call on TLT on a Friday that has a theta of negative 0.025, should I expect the option to be 0.05 lower in value by Monday morning, all else equal? How'd you go from 0.025 to 0.05? No. No. Theta just tells you what the decay is. So the option value should be lower by the amount of theta decay. I'm not sure why it's multiplied out like that. Why you've doubled it. What to do when I'm already bleeding TLT, but as yields get higher and higher, I feel the opportunity is getting more attractive. Is there anything better than dollar cost averaging? Well, not without capital. At some point you need capital. What you can do is you can move into bonds. That requires less capital. You can because with bonds you're paying not the face value, you're paying lower than face value. I wouldn't say it requires less capital, but it's probably a more efficient use of capital. With interest rates where they are, margin is super expensive, so I wouldn't touch margin. Sometimes just having patience is what we need, because the unknown and the unexpected happens anytime. Case in point, look what happened on the weekend, and TLT has had a good start to the week. Overall, it's had a good start to the week. And this is how I think TLT will be resolved. Will be one of these sort of unexpected, unforecastable things that happen out of nowhere that change our desire for risk. Fairly new to the game of developing personal trading strategies. Found some research articles that indicate tail risk is more probabilistic and likely to occur compared to how historical tail risk has been modeled in the past. I'm wondering from a market theory perspective, you believe if investors have already started to model tail risk differently to account for the potential increased quantity severity of tail risk events? I don't know that I'd say that they've done it differently. There are lots of measures of tail risk and different types of insurance that you can put in place to protect yourself from tail risk. The best protection from tail risk is a balanced portfolio, is a diversified balanced portfolio. And why do you think the quantity of tail risk events have been understated for such a long time? Well, I don't know that they've been understated. The reliance on a normal distribution understates them. But the normal distribution is your expectation. Keep in mind, it's a probabilistic distribution. It is your expectation given normal conditions, given conditions that don't include these events. But these events do happen. But to try to map it all on the same distribution, I don't know that it makes a lot of sense to do that. I think there's an understanding that for the most part we're on a particular distribution that works for the most part. But that's it. But let's be aware that it does not model tail risk very well, but it does model returns fairly well under non-stressed conditions. But it does not model tail risk. That's not new, by the way. That is not new. I can remember that 30 years ago, well before Nassim Taleb wrote Black Swan. That was around. That was around a long time ago. I can remember knowing about that, but it was like, how would you model it? And the best. It was difficult to model, but the best defense against it was a diversified portfolio. Not to get political, like you mentioned, immigration is a sensitive topic, but looking at the market from an objective lens, can you shed some insight on the impact of millions of illegal undocumented migrants coming into the U.S. on jobs data published? I see what you're saying on that. Is that when you're looking at the household survey, these people are not going to answer that survey. They're probably going to hang up because they don't want anything to do with that kind of question. But the establishment would say, yeah, we hired this many people, we hired that many people, and that some of them may actually be illegal or undocumented migrants. That's possible. It is possible. The thing I'm unsure about is whether these numbers get reported in the published jobs reports. Well, even if they do, even if they do, it's somebody in the country getting a paycheck, spending money. So other than a political thing, we have undocumented people taking jobs, from an economic perspective, it's meaningless. Like, it would not matter if the 10 people who got hired today were citizens or were undocumented migrants that are in the country illegally. From an economic perspective, it would not matter. It would matter from an economic perspective only to the extent that they send their earnings back to their home country. Then that money is leaving the country. It's not being spent within the country. Then it has less of an effect on the economy than if 10 citizens who live in the country were hired. Given your knowledge on how data for these reports is collected, is there any adjustments necessary for the published figures in factoring in illegal undocumented immigration? No, not at all. The only thing in there, and it doesn't capture it, would be the assumed level of population growth month after month. Because when you're calculating the size of the labor force, you have to account for population growth. So it would have a level of immigration in there, along with births and deaths that is based on numbers that are documented. As far as what's crossing the border illegally, that wouldn't find its way in. So perhaps the unemployment rate, counting everybody, is much higher. Yeah. What are your thoughts about the quality of recent jobs report? News headlines talk about job gains, but table A9 shows a decline in full-time jobs. Yep. Increase in part-time jobs. Yep. An increase in multiple job holders. If someone took 2 part-time jobs, would report them 2 new part-time jobs. No, the part-time is reported as full-time equivalents. So when we say part-time jobs added, full-time jobs lost, the part-times are on a full-time equivalent basis based on whatever the average weekly hours happen to be. They would be there on a full-time equivalent basis. So one job added, in part-time could be 3 different people that make up the full-time, that make up a full-time equivalent, right? The point is they are part-time hours as opposed to full-time hours. Yeah, there was a decline in full-time, an increase in part-time, that the job gains came at the expense of full-time workers for part-time workers. And when wages get too expensive and companies need to preserve margins, this is what they do, is they look for ways to decrease costs. And if I hire part-time workers, maybe they don't need benefits. Maybe I don't have to provide that, and I can pay less per hour than I normally would pay, and I can avoid a lot of paying for holidays if I schedule them appropriately in and around holidays, so I don't have to pay them for the holidays. Coping mechanism, sure. Risk reversal good on agency now. Yeah, well, if it's something that you want to own, then I would say sure, because your downside would be that you'd have it put to you at a lower price. You said there's 1% higher yield in the 30-year bond than in TLT. Is there not an opportunity to thus go short 100 TLT? No, because you would have to rebalance your 30-year bond to maintain a duration that TLT maintains. So no, I wouldn't say that there is an opportunity there. And you have to consider the timing of the cash flows. TLT pays its dividends monthly. The bond is every 6 months. So you would have cash outflows. 5 cash outflows before you have a cash inflow that matches your 6th outflow. So considering time value of money, you may or may not be ahead under those conditions. Now, the bond itself, unless you're buying it at par, the bond itself, the cash flow from the bond will not equal the cash outflow from TLT. Or it would be, I think it's 28 cents a month. 12 months, 280, that's $3.36 versus $3 inflow. So you'd have cash outflow over that period of time. And then you'd have the duration aspect of trying to manage that duration. So no, it wouldn't work out very well. Hard time understanding how this bear steepener is occurring. I understand that to produce a bear steepener, market participants selling off long bonds. Yep. Usually this is to allocate to shorter bonds. Yep. They believe in higher for longer narrative. Who is selling these bonds? So it's not, there is no silver bullet here. On the long end of the curve, I believe that there's probably 3 or 4 factors that you can point to that just all seem to be happening at the same time. For example, if we go back earlier, I said if the US dollar were weakening and oil prices were dropping, I don't think you'd see as much happening on the long end of the curve as you do now, because it would take the demand for US dollars, it wouldn't take it off the table, but it would lower the demand for US dollars such that some countries would not have to dip into the reserves to meet the demand for US dollars. So it's a confluence of factors all happening at the same time. I wouldn't say it's just one thing. So I don't know that it's worth asking the question, who is selling these bonds? Why don't we see short-term yields decreasing at the same time? Well, they're money market rates. It would be difficult unless you have significant inflows there. You show money market fund inflows increasing sharply. Yeah, increasing sharply, but issuance is increasing as well, right? But does this not seem to be affecting the benchmark yield curve? No. Elaborate on how it's being caused. Again, a confluence of factors, right? Lots of supply coming online. Concern that duration could go lower. You have some countries that need to sell treasuries to meet their demand for US dollars domestically, because energy prices are going up and the US dollar is going up. You have money transferring generations, because every day, look at the obituaries, there's a baby boomer dying somewhere that's passing on all of their investments to their kids, and maybe they're saying, well, let's use the money to pay down debt and do this. And okay, so dad was holding a bunch of bonds, let's sell the bonds. Our mom was holding a bunch of bonds, let's sell those. A whole bunch of factors. It's not just one thing. It's the sum of all of these things happening at the same time. Does recent instability in the Middle East, Israel, create black swan event for U.S. market? Potentially, yes. Potentially, yes. What are your thoughts on Israel-Palestine war, its impact on the market? So I've already answered those, and that takes us through this week.